Can you give us your take on how you think inflation is going to impact our markets?
Sure. Let's begin with very much, so bear with me as I'm going to skip forward a few slides, as you may be wondering. So 1 second, please. Let me get to that. Let me start with, where is inflation? I realize that my thumb perhaps is a little faster, and so it moves. Okay, I'm not going to touch it. Where is inflation today? And is it, as we call it, is the inflation genie out of the bottle and it's too late to pull her back in? So let's start with the left-hand side. The left-hand side looks at where inflation as measured by the Fed currently stands. And this is a little dated, so I'll give you the latest number. The latest number as of March is the target is at 2.4%, which looks like if you were to continue that line and from February take it up, it looks like it's gone straight up. A few things here. What is the Fed looking at? The Fed measures inflation by looking at a basket of goods and services using this index called the Personal Consumption Expenditures Index. Fancy way of saying it looks at a basket of goods and services and measures it. It is slightly different than how Social Security is indexed for inflation. So do note that if you look at that and say, hey, how come it doesn't match up? They're not one and the same. There are differences in how they measure components. I won't get into that. Happy to dive in, but likely will put us all to sleep. But nonetheless, let's look at, as of March, I mentioned inflation stood year over year at an increase of 2.4%. That's the number, which is not on the screen because it's 1 month delayed. Now, what is the Fed looking at? The Fed is looking to average 2% target, meaning that as inflation over a period of time, it needs to sustain itself at 2%. Look at the chart, and there's a dotted line underneath the Fed's 2% target. That is over the last 3 years, because inflation's been running so low, the average inflation currently sits at something like 1.7% or so. So still below the Fed's target. What would it need to get to in order to hit the 2%? Something like a sustained 2.4% for a period of 1 to 3 years. The Fed hasn't been very clear on how they're measuring the average rate. So first point, it is still below the Fed's rate of target in how they're looking at inflation. The difference here this time is that the Fed is not forecasting inflation, but rather waiting for inflation to come through. Why is that? Because over the last 10 years or so, we have seen, despite the amount of monies we have spent, that inflation has been non-existent. So they want inflation to be here and stay persistently before they make any directional changes. Why is that? I'll give you a little nugget here. Let's go to European Union 2011. We're in a little history lesson here. In 2011, we had a very similar scenario. The European Central Bank, the ECB, was looking at commodity prices, which was skyrocketing on a short-term period, which is exactly what we're experiencing now, due to some issues with China. The European Union and the central bank raised interest rates by 50 basis points, or 0.5%. As a result of that increase twice of 25 basis points, or 0.25% each, the European Union has struggled as a whole just because of those two rate increases. The Fed worries that they will be in a similar boat, in that they're going to start raising interest rates to curb inflation, but inflation is not really sustainable because it was transitory. That's the word you keep hearing the Fed using, that they think that the inflation we're seeing here is transitory. Why do they think that? Because of the chart on the right-hand side. The chart on the right-hand side looks at unemployment. And unemployment has certainly come from the peak of April 2020 at 14.8%, currently sits at 6.1%. When there is a big swath of people that are unemployed, the issue here, Adam, is that it's hard for wages to keep going up, knowing that there is a broad set of people still unemployed. Why do I talk about wages? Because the number one driver of inflation in any good and service is people, right? How much we get paid is what really drives the cost of goods and services. Now, we are seeing some temporary rises in the in wages, but is that because unemployment benefits are greater for a certain period of time? Yes, but is that going to go away? Also, yes. So right now what we're getting is a few very small data points that tells us, yes, commodity prices have risen. Why? Because demand went from 0 to 100, but supply couldn't keep up. As the supply normalizes, can that trend continue? Now that's $1 million question, but again, we don't have a definitive answer. So to draw a conclusion that the 1970s style inflation is here to stay is too premature. This requires us to watch the data point a little bit more closer and then draw a more definitive conclusion. So yes, inflation is rising, but rising from very low levels of April of 2020, where it fell off the cliff. Second, many of these are imbalances that we need to wait and see over the summer months how they balance out. And last but not least, it's too premature to think that inflation, like a 1970s style, is here and here to stay. We don't have the data points just yet to support that conclusion.